Hi, I'm excited you're back for another episode of Center for Tax Studies Individual Income Tax course. Today we're going to be getting into the most important part of tax. We're going to be discussing the tax formula. It's where everything stems from. All law refers back to and is relatable to the tax equation or the tax formula. So let's get started. Of the tax formula is that you need to be able to understand where all the rules apply. It helps in assisting to understand the purpose behind the rule in a lot of cases and how it will impact your tax client's ultimate tax responsibility. So this formula is used to compute taxable income for individual income tax payers. It starts off with income. This is from whatever source derived. It then is reduced by exclusions. Anything that Congress has determined that should not be included in the determination of tax. This brings you to gross income. Gross income is then further reduced by deductions for adjusted gross income or AGI. These are typically referred to as above-the-line deductions. Once you have those deductions removed, you then are left with adjusted gross income, or again, AGI. AGI is then further reduced by deductions from AGI or below the line deductions. These deductions include the greater of the standard deduction or itemized deductions. Or if you don't want to try and figure out itemized deductions, you can then just take the standard deduction or the easy deduction. And then you can also take personal exemptions and dependency exemptions if you have somebody that you can claim as dependent. Once these deductions are removed from AGI, this leaves you with taxable income. You then apply the tax rate to this taxable income. You can either apply it through the tax tables that go through and they show you, based off of your taxable income, how much tax should you then put on your tax return, or you can use the tax rate schedules and then apply the tax rates based off of the amount of taxable income and calculate your own particular tax. Once you apply the tax rate, you get your tax that you owe. However, you then further reduce your tax by tax credits and by any prepayment that you've put in through withholding or through your estimated quarterly tax payments. At this point, you then know what your tax is and the amount you either owe or the refund that is due to you. Let's go through and discuss each of those items just in brevities, because we're going to go through each of these items in a lot of specificity over the next several episodes. And by several, I mean a lot of episodes. The rest of this course is going to be on this. Okay, so what is income? The general definition is that income, except as otherwise provided, is all income from whatever source derived. This is the definition of income under the Internal Revenue Code, Section 61. Income is an increase. So anything that comes to you and increases your bank account or your coffers is income. However, it does not include a return of capital or a receipt of borrowed funds, since they must be returned. So you purchase a car and you are making payments on that car. When you received the money to be able to buy the car, that's not income to you because you're going to have to pay that back. And vice versa. If somebody owes you $100, when you get the $100 back from that person, you then don't have to report that as income because that was a loan. Okay, so let's give an example. Let's assume that your next door neighbor, who's a little bit older, asks you if you will mow her lawn in exchange for a batch of her famous chocolate chip cookies. You jump on this. You love these cookies because they're amazing. Now the question is, are the cookies income to you? And is the fact that you mowed her lawn income to her? And the answer is yes, it's income. Now, you're probably wondering, that's ridiculous. This is just a favor, but the fact that you received something in exchange for services actually is income to you. Now, is a revenue agent who goes through and decides to audit your tax return, is that person going to go after the money? Probably not. Or the value of the cookies? Probably not. However, a special agent may, because if there is tax evasion, they're going to go after whatever they can. All right, the next example is, let's say that you notice that the little old lady next door, that her lawn is looking a little bit long, and you go over and you mow the lawn for her. While you're doing this, your next door neighbor notices you mowing her lawn, and she says, "Oh my goodness, I can't believe you're doing this. I'm gonna make you some chocolate chip cookies because I just feel so good about the fact that you've done this for me." Now the question is, are the cookies and the lawn mowing income to each party? And the answer here is no. There was no bargain for exchange. In the last example, your next door neighbor said, "Hey, in exchange for mowing my lawn, I will make you cookies. Do you want to do it?" That was a contract. That was a bargain for exchange. But here, out of the goodness of your heart, as a gift, you gave a gift to her of mowing her lawn, and she gave a gift to you in appreciation of that. And I say, go for it. Those cookies are amazing. You don't have to include those in your income. Now, do you notice the difference? It's slight. Thus, many people don't report exchanges of income. There are a lot of unreported, under-the-table cash transactions going on in the United States that the IRS is trying to stop. Thus, any situation where there has been a trade, income should be reported. Now, here are a couple of examples of gross income. Alimony received, any award you receive for services, bonuses from your employment are included in income. Business income, capital gains. I love gambling winnings as well as prizes. A lot of people don't realize that prizes, when you call into that radio show and you win an all-expense paid trip to see Maroon 5 in Las Vegas, which hasn't happened to me yet, but I'm really hoping will, you have to include in income the value of what you've received from that radio show. Now we're going to go on to exclusions from income. The part of Internal Revenue Code Section 61A that says, except as otherwise provided, those are exclusions. And exclusions have to be written up. They have to be stated in the code as exclusions. These items are not placed on the tax return. You don't have to report them at all. And examples of these exclusions are bequests, inheritances, child support payments that you receive, gifts that you receive as long as they're under $14,000, group term life insurance premiums paid by an employer, meals and lodging provided for the benefit of the employer, ministers. If you have a dwelling and you receive a minister's dwelling allowance, you don't have to report that on your income tax return. Scholarships, if used for qualifying tuition, etc. Deductions for AGI. These are deductions that typically are business, but here are a list of the deductions for AGI. Ordinary and necessary expenses of a trade or business, rental expenses, 1/2 of self-employment tax that you pay, alimony paid. Moving expenses are great if you are moving for a particular job. We'll talk a little bit more about that in a later episode. All of these reduce your gross income to come to your adjusted gross income, or AGI. This is an important subtotal that only affects individual taxpayers, not corporations. It is commonly used to limit itemized deductions and create floors and ceilings for the ability to take a particular deduction. So a floor, for example, in casualty losses are only deductible if they exceed 10% of AGI. Whereas for ceilings, you can only take a charitable contribution as long as it does not exceed 50% of your AGI. There are additional limitations for medical deductions, charitable deductions, and other miscellaneous itemized deductions. And we'll talk about those in a subsequent episode as well. Deductions from adjusted gross income. So the general rule is that personal expenses are not tax deductible, except if they are itemized deductions. So you're allowed to take the greater of the itemized deduction or the standard deduction. And the standard deduction is a set amount determined by Congress. It is increased with inflation, or it is adjusted based off inflation rates. The following are examples of itemized deductions. So in 2016, medical expenses in excess of 10% of AGI, or if you're 65 or older, as long as they exceed 7.5% of AGI. You can take your state and local income taxes or your sales tax if you don't have an income tax in your state. You can take real estate taxes, personal property taxes, interest on home mortgage, investment interest, charitable contributions, etc. Now, you can also take casualty and theft losses as long as they exceed 10% of AGI, and then there are a bunch of miscellaneous expenses, union dues, professional dues, etc. If there was an asterisk on this chart, that just means that it is subject to additional certain limitations. We'll go over those in another episode. As a part of deductions from AGI, you also get to take your personal and dependency exemptions. These personal and dependency exemptions are adjusted for inflation and are a set amount. So for 2016 and 2017, it's $4,050. Examples of non-deductible expenses are personal living expenses. I'm going to Ulta later and I'm not going to be able to take the makeup that I purchase. Hobby losses, there are some exceptions to that. Expenses for jury duty, gambling losses in excess of gains, child support payments, and expenses that you pay for another person. All right, this comes back to your taxable income. Once you determine what your tax is based off of your tax rates, you then will have either what is owing to the IRS or what the IRS owes you in the form of a refund. Tax rates are determined by your filing status, whether you're single, married, filing jointly, married, filing separately. You have a dependent but you're single and therefore you're filing as head of household, etc. Once you've determined your tax, then you can reduce your tax if you qualify for certain tax credits and if you have paid withholding or estimated tax payments, which I hope you did, because otherwise you're probably in trouble and you're going to have interest and penalties as discussed in a previous episode. Credits are great. Credits are dollar for dollar reductions in your tax. There are only a small number of credits as a result, and you can see these here. Tax credit for rehabilitation expenses, work opportunity tax credits, research activities credits or research and development tax credits, low-income housing, child tax credits, and if you go down to the bottom, these are typical tax credits that most people have heard of. Child tax credit, the credit for child and dependent care expenses, education credits, energy credits, like when you were able to take a credit for putting more insulation in your house, or credits that you would be able to receive if you purchased a energy efficient vehicle. All right, that leaves you with the amount owed to the IRS or your refund due. Thank you so much for watching this. I hope it was at least a little bit interesting for you so that you now know what is in your tax return. If you liked this, please give it a thumbs up. If you have any questions about what we discussed today, feel free to leave a comment in the comment box below. I love to answer questions in regards to tax. Also, you can email us at centerfortaxstudies@gmail.com. Thank you so much for watching, and you'll hear from us soon.